Silver $100 shattered. Banksters panic as Shanghai hits. New highs Friday, January 23rd, 2026. A threshold that held for decades just collapsed. Silver breached 99 on 16 in Western markets. But that's not the real story. Shanghai closed at 111.66, a $12 premium that should not exist. Major banking institutions are now facing a mathematical problem, one that cannot be solved with paper contracts. The arbitrage algorithms are screaming. Physical metal is flowing east at unprecedented rates, and the derivative positions, they exceed the available supply by ratios that would make 2008 look contained. What happens when the world's most manipulated market finally breaks free? Welcome to Silver Radar, the channel where we track what the financial establishment hopes you'll ignore. Now, if you've been watching markets long enough to remember when a dollar actually bought something, if you understand that real wealth isn't measured in paper promises, then you know the value of having a reliable source that cuts through the noise. We'd be honored if you'd subscribe, not because we're chasing numbers, but because critical analysis deserves a committed audience. And before we dive into what's really happening in these markets, tell us in the comments, where are you watching this from? New York, London, Sydney, Mumbai? Because what's unfolding right now, it's not confined to one time zone, and your perspective matters. Now, let's examine exactly what shattered on January 23rd, and why the people managing trillions in derivative exposure aren't sleeping tonight. The Globex trading screen flickered with a number that should not exist. 99.16. The electronic pulse of Western precious metals markets had just crossed into territory that major financial institutions spent decades defending. Friday, January 23rd, 2026. The clock on the trading floor read 9:47 a.m. Eastern Time. History was being written in real time, one tick at a time. The price movement was not gradual, it was violent. Every few seconds, another barrier shattered. 98.20, 98.67, 98.89. The resistance levels that held for weeks evaporated like morning fog under a brutal sun. Traders watching their monitors saw something they had never witnessed in their careers, a market breaking free from invisible chains. 3 weeks earlier, the battle lines had been drawn at $95. The short sellers, those betting against silver's rise, threw everything they possessed at that level. Paper contracts flooded the market. Sell orders in quantities that exceeded annual mine production appeared within minutes. The message was clear: this far, no further. It failed. The $95 wall crumbled after 48 hours of sustained buying pressure. Physical demand overwhelmed paper supply. Delivery requests arrived faster than they could be processed. Something fundamental had shifted in market psychology. The fear of missing out replaced the fear of losing money. Margin call notifications began lighting up trading desks across lower Manhattan. When prices move against leveraged positions, brokers demand additional collateral. At $96, the calls were manageable. At $97, they became concerning. At $98, they approached catastrophic. Risk management systems, programmed to automatically liquidate positions beyond certain thresholds, started triggering. The defensive fortress at $98 was supposed to be impenetrable. Major banking institutions coordinated their efforts. Media outlets published articles questioning silver's fundamentals. Analysts appeared on financial television networks warning of an imminent correction. Technical analysts drew charts predicting reversals. None of it mattered. The market walked through $98 like it was not there. Inside the trading operations of institutions with massive short exposure, screens displayed numbers that made seasoned professionals physically ill. Red dominated every monitor. Losses accumulated not in thousands or millions, but in figures requiring exponential notation. The derivative positions, carefully constructed over years to profit from silver's suppression, had become weapons pointed at their creators. This was not theoretical anymore. In 1980, the Hunt brothers attempted to corner the silver market. Prices reached $50 before the exchange changed the rules and crashed the market. That was about price. This was about solvency. In 1968, the London gold pool collapsed when European central banks could no longer supply physical gold at the fixed price of $35. That was about central banks. This was about commercial banks. The mathematical reality was inescapable. When short positions exceed available physical supply by ratios of 100 to 1, and prices move against you by 40% in 3 weeks, capital adequacy becomes a fantasy. Basel III. Regulations require banks to maintain certain ratios of capital to risk-weighted assets. Those ratios were deteriorating by the hour. Volume bars on the charts exploded to levels previously seen only during major crisis events. Over 200 million ounces worth of paper contracts changed hands in a single morning session. The entire annual production of silver mines worldwide is approximately 1 billion ounces. In 4 hours, traders exchanged paper claims on 20% of global annual supply. Counterparty risk meters entered danger zones. In derivative markets, every contract requires two parties. When one side cannot pay, the other side faces default risk. When multiple parties cannot pay simultaneously, the entire system faces contagion risk. Trading desk algorithms designed to monitor systemic stability began sending alerts to risk committees. The COMEX registered silver inventory, the physical metal available for delivery against futures contracts, had fallen to levels not seen since the exchange's founding. Less than 30 million ounces remained. The open interest, the number of contracts requiring potential delivery, exceeded 300 million ounces. The ratio had become absurd. Social media platforms exploded with silver discussions. Retail investors who spent years accumulating physical metal watched their net worth transform. Skeptics who mocked them as conspiracy theorists fell silent. The thesis was proving correct in the most public way possible. But those watching only Western markets were missing the real story. As New York tentatively touched $99, something far more significant was occurring 8,000 miles away. In Shanghai, where the sun had already risen on Saturday morning, the silver market was not testing triple digits. It was running wild through them. The camera perspective shifted east, following the path of physical metal flowing across the Pacific Ocean toward the world's largest manufacturing economy. The Shanghai Gold Exchange opening bell rang at precisely 9:00 a.m. local time. What happened in the next 8 hours would fundamentally alter the global monetary architecture. While Western traders slept, the East was rewriting the rules of commodity pricing. The price board displayed a number that seemed impossible, 24,997 yuan per kilogram. Traders accustomed to Western spot pricing needed a moment to process the conversion. 111.66 per ounce. Not 99, not 100, not even 105. The gap between East and West had become a chasm, a $12.50 premium that violated every principle of efficient market theory. In functional global markets, such price differentials should not exist for more than minutes. Arbitrage traders exist specifically to eliminate them. Buy in the cheap market, sell in the expensive market, pocket the difference. Yet here it persisted, hour after hour, day after day, week after week. Something had broken in the machinery of global finance. The single session gain told its own story, up 8.5% in a market where 2% moves typically dominated headlines. Chinese buyers were not nibbling at the edges. They were devouring everything available. Bid orders stacked 20 deep at prices. Western traders considered irrational. The desperation was palpable, even through cold electronic data. Side-by-side comparison screens painted a picture of two separate realities. New York, cautious, hesitant, still bound by decades of price suppression psychology. Shanghai, aggressive, confident, liberated from Western monetary constraints, the same metal, two completely different valuations. The global price discovery mechanism had fractured. Historical volatility charts revealed how unprecedented this moment truly was. Silver typically moved in orderly patterns, contained within predictable ranges. The statistical models used by every major trading algorithm assumed normal distribution, bell curves, standard deviations, predictable chaos. Those models were now worthless. The market had entered a regime change that historical data could not capture. Inside Shanghai trading facilities, the atmosphere resembled a gold rush. Traders shouted orders. Phone lines stayed constantly engaged. Physical delivery demands overwhelm processing systems. This was not speculation. This was accumulation, strategic, systematic, unstoppable. Meanwhile, at Pudong International Airport, cargo planes lined the tarmac. Their manifest, silver bars, thousands of them. Each flight carried 10 to 15 tons of physical metal. Destinations, Shanghai, Shenzhen, Hong Kong. The flow of silver from west to east had transformed from stream to torrent to flood. Western vault facilities told the mirror image story. Security cameras recorded the same scene repeating endlessly. Forklifts removing pallets, trucks departing half empty, inventory management systems flashing yellow warnings turning to red alerts. The physical metal was leaving, not slowly, rapidly. The London Bullion Market Association vaults, which held the Western world's primary precious metals inventory, showed depletion rates that would have seemed impossible 6 months earlier. Weekly reports documented drawdowns of millions of ounces. The reserves built over decades were evaporating in weeks. Arbitrage traders calculated the profits obsessively. Buy at $99 in New York, sell at $111 in Shanghai. $12 per ounce on a 100,000-ounce position that represented $1.2 million in pure profit. On a million-ounce position, $12 million. The opportunity was obvious. The execution was not. Export restrictions materialized like landmines in the path of profit. Governments protecting strategic resources. Regulatory agencies demanding documentation. Compliance departments requiring approvals. The bureaucratic friction that should not exist in globalized markets suddenly became very real. Insurance costs exploded. Underwriters recognized the geopolitical sensitivity. Policies that once cost thousands now required millions. Shipping logistics became nightmares. Routes that previously took 3 weeks now required 6. Every delay represented lost profit as prices continued diverging. The fundamental difference between markets became impossible to ignore. COMEX futures operated on leverage ratios of 250.1. For every ounce of physical silver, 250 ounces of paper claims existed. The system functioned only because most traders never demanded delivery. It was a confidence game. A beautiful, fragile, highly profitable confidence game. Shanghai Gold Exchange operated differently. 100% physical backing. Every contract required real metal. No paper promises. No leverage fantasies. When you bought silver in Shanghai, you bought actual silver. When you sold, you delivered actual silver. The concept was revolutionary in its simplicity. This structural difference explained everything. Western markets could suppress prices through infinite paper creation, create 1 million ounces of paper silver with a few keystrokes, flood the market, drive prices down. Shanghai could not play that game. Physical metal is finite. You cannot print it. You cannot create it from nothing. You must mine it, refine it, transport it, store it. The Chinese Strategic Commodity Accumulation Program, quietly operating since 2015, was now visible to anyone paying attention. For 11 years, Beijing systematically purchased silver at suppressed Western prices, billions of dollars deployed, hundreds of millions of ounces accumulated. The patience was remarkable. The execution was flawless. The timing was perfect. The Belt and Road Initiative required silver. Infrastructure projects across 70 countries, solar installations, electrical grids, manufacturing facilities. The industrial demand was real, massive, and non-negotiable. China was not speculating. China was building. Yuan internationalization, the decade-long effort to challenge dollar dominance, had found an unexpected ally in silver. Commodity backing provided credibility that paper promises lacked. While Western currencies raced toward infinite digital expansion, the East was anchoring to tangible assets. The dollar-denominated commodity pricing system, established after World War II and reinforced after 1971, was experiencing its first genuine challenge. Not from another paper currency, from physical reality asserting itself against financial abstraction. Global maps displayed the capital flow in brutal clarity, arrows moving from west to east, from paper to physical, from leverage to substance. The great monetary rebalancing was not a theory anymore. It was measurable, visible, undeniable. The drainage pattern resembled something from geology, watershed moments where everything flows in one direction. Past a certain threshold, reversal becomes impossible. The question was no longer if Western prices would converge with Eastern prices. The question was when and how violently. The Fresnillo mine in Zacatecas, Mexico, had been producing silver for 400 years. The Spanish conquistadors found it. The Mexican Republic nationalized it. Modern corporations industrialized it. But in January 2026, the mine faced something none of its previous operators had encountered. The ore was running out of silver. Not completely, not dramatically, just gradually, inexorably, economically. Where miners once extracted ore containing 300 grams of silver per ton, they now celebrated finding 150. The easy silver, the rich veins that made fortunes, had been harvested. What remained required twice the effort for half the reward. Across the Pacific, in the Peruvian Andes, the Antamina mine told the same story through different numbers. Ore grades declining at 3% annually. Energy costs rising at 7% annually. The mathematics were not complicated. Eventually, the equation stops working. That moment was approaching faster than anyone publicly admitted. Chinese domestic silver production, which had grown aggressively for 2 decades, hit a wall that no amount of government directive could overcome. The accessible deposits were exhausted. The remaining reserves sat beneath protected agricultural land, populated villages, ecologically sensitive regions. Communist Party efficiency met geological reality. Reality won. Exploration budgets revealed the strategic mistake. Between 2015 and 2025, major mining companies reduced silver exploration spending by 60%. Shareholders demanded returns, not long-term investment. Executives responded rationally to incentive structures. The consequence was predictable. No new major silver discoveries, no replacement deposits, no future supply. Meanwhile, solar panel manufacturing facilities operated around the clock. Each photovoltaic cell required silver paste for electrical conductivity. No substitute existed with comparable efficiency. Every panel consumed approximately 20 grams. Global solar installations were projected to reach 500 gigawatts annually. The calculation was straightforward. 10,000 tons of silver demanded by a single industry. 20% of global mine production. Every year. Forever. The assembly lines never stopped. Panels rolled off production faster than they could be shipped. Climate commitments demanded renewable energy. Renewable energy demanded silver. The demand curve was not negotiable. It was governmental policy, backed by international treaties, signed by 193 countries. Electric vehicle manufacturing added complexity to the supply equation. Each vehicle contained 1 to 3 kilograms of silver, depending on the model. Electrical contacts, circuit boards, battery management systems, charging infrastructure. The automotive industry was electrifying at unprecedented speed. 20 million electric vehicles annually by 2026, 40 million projected by 2030. The silver requirement was staggering. 5G cellular networks blanketed the planet with technology that consumed silver at rates 4G networks never approached. Each cell tower, each router, each connection point. Silver's unique properties, highest electrical conductivity of any element, highest thermal conductivity, superior resistance to oxidation, made it irreplaceable in high-frequency applications. Semiconductor fabrication plants, the advanced facilities producing the chips powering modern civilization, required silver in quantities most people never considered. Bonding wires, circuit printing, specialized solders. The global chip shortage of 2021 to 2023 had triggered massive fabrication facility construction. Every new fab demanded thousands of kilograms of silver. Dozens of new fabs were under construction. Medical device manufacturers faced similar constraints. Silver's antimicrobial properties made it essential for surgical instruments, wound dressings, catheter coatings, diagnostic equipment. An aging global population demanded more medical procedures. More procedures demanded more silver. The demographic trend was irreversible. Water purification systems in developing nations increasingly relied on silver-based filtration. 2 billion people lacked access to clean drinking water. International development agencies invested billions in purification infrastructure. Silver's ability to kill bacteria without chemical additives made it the technology of choice. The humanitarian demand was enormous. Simultaneously, investment demand accelerated beyond all projections. Silver ETFs accumulated metal at rates that shocked even the fund managers administering them. The largest funds added 50 million ounces in the first 3 weeks of January alone. Investors were not buying paper claims anymore. They demanded physical backing, fully allocated, independently audited, actually existing. Retail bullion dealers experienced something between a rush and a panic. Their shelves, typically stocked with thousands of coins and bars, emptied within days. Premiums over spot price, normally $2 to $3 per ounce, exploded to $8, $10, $12. Customers did not care. They wanted metal. They wanted it now. They would pay whatever necessary. Central banks, historically focused exclusively on gold, were reassessing silver's strategic value. Confidential memos circulated through monetary policy committees. Diversification discussions mentioned silver alongside gold. The institutional buying had not begun yet, but the groundwork was being laid. When central banks moved, they moved with size. Inflation hedging strategies. Spreadsheets told a compelling story. Over 5 years, silver outperformed inflation by 300%. Over 10 years, by 500%. Over 20 years, by 800%. Financial advisors who once dismissed silver as speculative were recommending 5 to 10% portfolio allocations. The Silver Institute's annual supply-demand report, published in early January, contained numbers that should have dominated financial headlines. Annual deficit, 230 million ounces. Production, 900 million ounces. Demand, 1,130 million ounces. The gap was not closing, it was widening. Above-ground inventory analysis revealed the horrifying truth. Excluding jewelry and silverware, approximately 2 billion ounces of silver existed in various forms. At current deficit rates, that inventory would be depleted within 8 years. Exchange-registered stockpiles, the metal available for immediate delivery, represented less than 2 months of global industrial demand. The graphs showed lines crossing, supply declining, demand rising. The intersection point represented market failure, price spikes, allocation systems, industrial rationing, strategic reserve releases, the mechanisms governments employ when markets stop functioning. Recycling facilities operated at maximum capacity but could not bridge the gap. Recovering silver from old electronics, photographic materials, and industrial waste provided approximately 180 million ounces annually. Helpful but insufficient. The deficit remained. Secondary supply faced fundamental limitations. Silver's industrial uses often involved dissipative applications. The metal was used in microscopic quantities across billions of products. Recovering it was economically impractical. Unlike gold, which was treasured and recycled endlessly, silver was consumed and lost. New mine development timelines mocked the urgency of demand. From initial exploration to commercial production required 7 to 10 years under optimal conditions. Environmental regulations, permitting processes, community consultations, infrastructure construction, each added delays. Accelerating the timeline was impossible. Mining operated on geological time, not market time. New mine development timelines mocked the urgency of demand. From initial exploration to commercial production required 7 to 10 years under optimal conditions. Environmental regulations, permitting processes, community consultations, infrastructure construction, each added delays. Accelerating the timeline was impossible. Mining operated on geological time, not market time. Environmental restrictions had become increasingly stringent. Communities near proposed mining sites organized resistance. Indigenous rights movements opposed development on ancestral lands. Conservation groups protected habitats. The social license to operate was harder to obtain than the government license. Energy costs made marginal deposits uneconomic. Silver mines required enormous amounts of electricity for extraction and processing. With energy prices elevated globally, deposits that were profitable at $20 silver became marginal at $30 and uneconomic at $40. Rising prices should incentivize new supply. In silver's case, rising costs offset rising prices. The distinction between structural and cyclical deficits became critical. Cyclical deficits resolve themselves. High prices incentivize new production. Demand destruction occurs, markets equilibrate. Structural deficits persist despite price increases. Supply cannot respond quickly enough. Demand cannot decline significantly. The imbalance becomes chronic. This was structural. The manufacturing base of global civilization had committed to technologies requiring silver. Changing those technologies would require decades and trillions in investment. It was not happening. The silver would be found, or the technologies would fail. Price elasticity, the economic principle that higher prices reduce demand, had stopped functioning. At $20 silver, solar panel manufacturers sought alternatives. None existed. At $30, electric vehicle makers redesigned systems to minimize silver content. They saved 15%. Demand still grew faster than supply. At $50, semiconductor fabs considered substitution. The performance degradation was unacceptable. The paper-silver market had hidden this reality for decades. When prices rose, banks created more paper contracts, suppressed the price increase, and prevented the supply response from triggering. The system worked beautifully until physical demand exceeded physical supply. Then, the entire structure revealed itself as a sophisticated illusion. Derivative market vulnerability connected directly to physical shortage. Every paper contract ultimately represented a claim on physical metal. When the claims exceeded the metal by factors of 100 or more and physical demand surged, the paper market faced a crisis. Honor all contracts and exhaust inventories. Default on contracts and destroy market credibility. Neither option was acceptable. The camera perspective shifted from mines and factories to the gleaming towers of financial districts, where banking executives confronted a problem that could not be solved through creative accounting or regulatory forbearance. The lights in the headquarters of J.P. Morgan Chase burned at 3 a.m. Emergency meetings do not wait for convenient hours. In the 52nd floor conference room, risk management executives stared at spreadsheets that represented potential institutional extinction. The derivative exposure had transformed from a profitable trading operation into an existential threat. The numbers on the screens were not abstract. Each row represented billions in notional value. Each column calculated mark-to-market losses. The totals exceeded the bank's quarterly earnings. Then they exceeded annual earnings. Then they approached levels that threatened capital adequacy. The speed of deterioration was what terrified them most, not months, weeks, not weeks, days. Basel III regulations, the international banking standards implemented after 2008, required specific capital ratios. Banks must maintain core equity equal to at least 8% of risk-weighted assets. Silver derivative positions carried risk weights. As losses mounted, the ratios deteriorated. Below regulatory minimums meant forced deleveraging. Forced deleveraging meant selling assets into falling markets. That meant more losses. The death spiral had a name: systemic contagion. Across the Atlantic, similar scenes unfolded in London. HSBC, Barclays, Standard Chartered. The global banking system was interconnected through derivatives. When one institution faced silver exposure problems, counterparty risk spread like wildfire. If J.P. Morgan could not pay its obligations, who else was at risk? If HSBC faced capital problems, which institutions held their derivatives? The mark-to-market accounting rules forced transparency that banks desperately wanted to avoid. Every day, they must revalue positions at current market prices. Every day, the losses grew. Every day, the capital ratios worsened. The regulatory reports would be filed. The auditors would see them. The ratings agencies would respond. The credit default swap spreads would widen. The funding costs would increase. The spiral would accelerate. Historical precedent offered no comfort. Bear Stearns collapsed in 2008, not from subprime mortgages directly, but from counterparty fear. When market participants stopped trusting the bank's ability to meet obligations, liquidity evaporated overnight. A firm with 85 years of history disappeared in 4 days. The trigger was surprisingly small, a few billion in losses. The silver derivative exposure at major banks was not a few billion. It was multiples of that. Lehman Brothers followed similar trajectory. September 15th, 2008. The largest bankruptcy in American history. The cause was not a single bad bet. It was interconnected complexity, meeting loss of confidence. The silver market in January 2026 contained all the same ingredients: leverage, opacity, counterparty exposure, contagion risk. The chemistry was identical. But silver was not happening in isolation. Gold prices moved in tandem, breaking through $3,200 per ounce. Bitcoin surged past $135,000. Ethereum followed. Cryptocurrency markets, often dismissed as speculation, were trading in perfect correlation with monetary metals. The message was unified. Inflation hedges rising simultaneously signaled monetary system distrust. Sovereign bond spreads widened dangerously. The difference between German bond yields and Italian bond yields exceeded 300 basis points. Markets were discriminating between strong and weak sovereign credits. The Eurozone debt crisis playbook was being reopened. When commodity prices spike and bond markets fragment, central banks face impossible choices. Real interest rates had entered deeply negative territory. Nominal rates remained near zero while inflation accelerated past 6%. Real returns of negative 6% meant savers lost purchasing power guaranteed. This environment historically drove investors toward tangible assets: precious metals, real estate, commodities, anything that could not be devalued through printing. The M2 money supply chart resembled a vertical cliff. From 2020 to 2026, the supply had increased by 60%. 60% more currency chasing goods and services. The inflation was not a mystery, it was mathematical certainty. What surprised economists was the delayed reaction. Inflation remained subdued through 2023. Then it arrived with violence in 2024. By 2026, it was accelerating beyond control. Currency velocity, the rate at which money changes hands, had collapsed during COVID and never recovered. The massive money printing did not trigger immediate inflation because velocity fell proportionally, but velocity was recovering. Each quarter showed improvement. When 60% more money circulated at normal velocity, prices would not rise 60%. They would explode beyond that as panic and hoarding behavior emerged. Central bank emergency conference calls were scheduled for Monday morning. The Federal Reserve, European Central Bank, Bank of England, Bank of Japan, People's Bank of China. The coordination required was unprecedented outside wartime. Trading halts were discussed, position limits considered, emergency lending facilities evaluated. None of the options were good. All of them were necessary. Trading halt proposals faced immediate resistance. Stopping silver trading would not stop the problem. It would amplify panic. Investors unable to exit positions would sell everything else. The cascade would spread to other markets: gold, copper, oil, equities. The attempt to contain one fire would ignite 10 others. Position limits, restrictions on how much any single entity could hold, came too late. The concentrated short positions existed now. Forcing their liquidation would trigger the exact price spike regulators hoped to prevent. Not forcing liquidation meant allowing continued manipulation. The regulatory trap was perfect. Margin requirement increases, the traditional method of cooling overheated markets, had already been implemented 3 times in January. Each time, the buying continued. At some point, increased margins accelerate panic rather than preventing it. Traders forced to post more collateral must sell other assets. Those sales depress other markets. The contagion spreads. Force majeure clauses, the contractual provisions allowing non-performance during extraordinary events, were being reviewed by legal departments. Could banks invoke force majeure to avoid delivering silver? Technically, perhaps. Practically, it would destroy the credibility of commodity exchanges forever. Who would trade futures if exchanges could cancel contracts unilaterally? The cure would be worse than the disease. Electronics manufacturers faced immediate crisis. Silver was essential. Prices were exploding. Profit margins were evaporating. Production delays meant contract penalties. Passing costs to customers meant lost competitiveness. The options were bankruptcy or government bailout. Dozens of manufacturers faced this choice simultaneously. Renewable energy sector supply chains fractured under pressure. Solar panel production depended on silver. Silver supplies were constrained. Panel prices increased 40% in 3 months. Government renewable energy targets became economically impossible. Climate commitments collided with commodity reality. Something had to give. Corporate treasury departments received urgent directives from CFOs. Reassess all cash positions, evaluate precious metal allocations, consider strategic inventory of critical materials. The corporate world was preparing for supply chain disruption that made COVID shortages look manageable. Strategic inventory decisions created their own problems. When corporations began hoarding silver for industrial use, they removed supply from the market. Reduced supply meant higher prices. Higher prices meant more hoarding. The behavioral feedback loop was self-reinforcing. Rational individual decisions created collective disaster. The 1973 oil crisis offered historical parallel. OPEC reduced supply. Prices quadrupled. Economies crashed. Inflation exploded. Governments responded with price controls and rationing. The controls worsened shortages. The rationing created black markets. The crisis lasted a decade. Silver in 2026 followed the same script with different actors. The 2008 financial crisis provided another template. Subprime mortgages triggered banking collapse. Banking collapse froze credit markets. Frozen credit crashed the real economy. Unemployment reached 10%. The recovery required a decade. That crisis started with housing. This crisis started with commodities. The contagion mechanisms were identical. But this crisis contained a unique element, the East-West divide. In 1973 and 2008, the Western financial system was unquestionably dominant. In 2026, China held the physical metal. Shanghai set prices. Beijing made strategic decisions so independent of Washington. The crisis was not just financial, it was geopolitical. The split screen showed the duality perfectly. Eastern Hemisphere sunrise illuminating Shanghai's skyline, vaults full of silver, factories running at capacity, a civilization powered by tangible assets. Western Hemisphere sunset over Manhattan, empty vaults, shuttered factories, a financial system built on digital promises. Discovering those promises had expiration dates. The final realization settled over the banking executives in their emergency meetings. This was not a liquidity crisis that central banks could solve with temporary lending. This was not a confidence crisis that could be managed with reassuring speeches. This was a physical reality crisis. The metal did not exist in sufficient quantities to honor all claims. Math could not be negotiated with. Geology could not be persuaded by monetary policy. January 23, 2026 would be remembered not as the day silver crossed $100. It would be remembered as the day the 50-year experiment in purely fiat currency confronted its fundamental limitation. Paper promises are infinite. Physical reality is finite. When the two collide, reality wins. The question facing governments, central banks, corporations, and investors was no longer whether the system would change. The question was how chaotic the transition would be, who would bear the losses, and what would emerge from the restructuring. The cameras pulled back slowly, from the conference rooms to the city streets, from the trading floors to the mining operations, from the vaults to the factories. The global economy, interconnected and complex, faced a reckoning that decades of financial engineering had postponed but not prevented. Silver was not the cause. Silver was the symptom. The underlying disease was monetary inflation meeting resource constraints. The treatment would be painful. The recovery would be long. The lessons would be expensive. But for those who understood what was happening, who recognized the patterns, who positioned themselves ahead of the crisis rather than reacting to it, January 23rd represented not disaster, but transformation. Not ending, but beginning. Not collapse, but rebalancing. The screen faded to black. The story was not over. It was just beginning.